Easy Exponential Moving Average Scalping Strategy. This video is for educational purposes only and should not be considered financial advice. The 200 EMA with the 4 EMA and a break of structure can really yield easy trades. In this video, we will go over an easy EMA strategy that you can use with any asset on any time frame. Plot the following on your chart: a 200 EMA and a 4 EMA with a shift of 4. You can also use a 50 EMA to help as well. For buy trades, when price closes above the 200 EMA, wait for price to return back to the 200 EMA. A break of structure must have occurred. When price touches the 200 EMA, then closes above the 200 EMA and the 4 EMA with a shift of 4, enter the trade. Put your stop loss behind the previous candle. For sell trades, it's just the opposite direction. When price closes below the 200 EMA, wait for price to return back to the 200 EMA. And a break of structure must have occurred. And then, when price touches the 200 EMA, then closes below the 4 EMA with a shift of 4, enter the trade. And again, put your stop loss above the previous candle. Your exit is when price reaches 1.5 times of your risk, or when liquidity is taken, or between the 20th and 25th candle after it crosses a 50 EMA, or when price closes below the 4 EMA shift of 4. Exit the trade. For sell trades, again, when price reaches 1.5 times your risk, when liquidity is taken, or between the 20th and 25th candle after a cross of the 50 EMA, or when price closes above the 4 EMA shift of 4, exit the trade. Risk management. Always make sure you are exercising proper risk management. Only risk 1% of your account per trade. Your stop loss should be, in this case, above or below the previous candle, but you may want to consider above or below the closest swing high or low. Your take profit, again, should be at least 1.5 times your risk, and your trailing stop is the 4 EMA shift of 4. In this example, we see the first break of structure occurs here, and price broke below the 200 EMA. Then we see price returning back to the 200 EMA, and now we want to look for our trade. And when price closes below the 200 and the 4 EMA, that is our entry right there on that candle. Now, as we've seen in our other videos, you can count the number of candles from when it crossed either the 4 EMA or the 50 EMA. And again, down here, remember we said between the 20th and 25th candle is when price will return back to the 50 EMA. Well, on the 20th candle could have been your exit. And you do get 1.5 times your risk. In fact, you get more than that. Our next example happens right after it. You see a break of structure. Price closes above the 200 EMA, then returns back below it, and then closes above the 4 EMA. Now, in this one, you might not want to take the trade because it did not cross the 200 EMA coming back. But you could have, and then you would have exited on this candle because you've already taken liquidity and you've moved more than 1.5 times your risk. So this is a lower probability trade, but it still was a good trade. Now, further on during this New York session, you see a break of structure. After price closed above this swing high, confirmed by the MACD that is green, price closed above the 200 EMA. That's our first condition. The break of structure is our second condition. Then price returns back to the 200 EMA and then closes back above it and above the 4 EMA. That's your entry. And as you see, you definitely get 1.5 times your risk, which is below the previous candle. And if you count, it's on the 18th candle. That's right before the 20th. And you can probably surmise that price could reverse because of the smaller candle that happens here. Price fails to close above this candle, which gives you an indication that there may be some movement to the downside as a retracement. In this example, we see there's a break of structure. Price closes below the 200 EMA, then it returns back, goes above the 200 EMA, then it closes below the 200 and the 4 EMA. That would be your entry. You can put your stop loss behind the previous candle, or if you want to be more on the safe side, you can put it behind the swing high. Price continues to the downside, takes liquidity, and then on the 22nd candle would be a legitimate exit, which is definitely 1.5 times your risk. But you may stay in the trade because price does not close above the 4 EMA until here. Always back test and forward test your strategies to see what it looks like in different environments. It is always a good idea to back test a strategy 100 times and then forward test it 100 times for best results. Take notes. Always take notes of details during your back testing and forward testing. These notes will help you to recognize market fluctuations and fake outs. We hope you enjoyed watching our video, and please like and subscribe for more videos like these. If you have a question or comment, please post it in the comment section below. Thanks for watching.